to Baku, Azerbaijan. We are here to discuss today the subject of transfer pricing. What is transfer pricing? That's what we're all about. So before I started out in international structuring, I had this idea. I thought to myself, well, hey, if I have a company in, let's say, Canada, why can't I just set up a company in a country that has zero tax, like BVI or Belize or something like that, and charge them management fees or consulting fees or marketing fees, and what can they do about it? Well, the truth is they have rules against that. They kind of realize that that can be a situation, and so they prevent it. So these rules are what's called transfer pricing rules, okay? So to understand the way that transfer pricing rules work, transfer pricing is any time you have a cross-border, non-arm's length transaction. So if you have one person or company doing business with another in another country, okay, and those are somehow related. So for example, if they share ownership, so I own both of them, and there'll be a threshold. You know, if you own, as an example, 1%, then it probably doesn't cross over. If it's 50%, then it probably does, and so on. So it's going to vary from country to country on the rules, and you need to look into those. Or for example, if it's owned by my brother, if it's owned by my mother, anytime that it's a related party, and the rules go country to country what a related party is, so they don't necessarily follow GAAP or IFRS rules, and so you have to look it up. Now, the way that it works, the general gist of it is if you're doing a transfer pricing relationship, if you're billing from one company to another across borders and they're related, you need to do it as though it's at an arm's length standard, meaning that I'm billing the same amount to my own company or to my related company as I would to an unrelated third party. Okay, so for example, what I would charge my own company for marketing, or what I would pay to my own company for marketing, is similar to what I would pay if I hired some random marketing company. Okay, now often this is difficult to figure out, and so you have to do something called a transfer pricing study. Now, from country to country, some of them require that you document a proper study, some of them don't. Most countries have transfer pricing rules, but not all of them do, so this is something to look into. These rules, the way that it will work is, okay, so I'm going to go and I'm going to do this study, and what I'm going to do is I'm going to try and figure out what is a fair way of determining it. Now, depending on the country you're in, some countries have very clear guidelines. Okay, so for example, in Brazil, they have some really clear, it's a fixed margin is what they call it, the rules. In other cases, you have, say, the US, there's like 5 different transfer pricing methodologies that you can do to figure out the pricing. And in theory, you can go with any of them. However, if it's not one that really makes sense, then in the event of an audit, the IRS may challenge it. And then you can go to court and fight over, hey, it shouldn't be this method, it should be that method. So in the US and in a bunch of other countries like it, you need to first of all do a transfer pricing study, which is going to figure out, hey, here's the fair market value, and you're going to document why you used the pricing method that you did and how it worked and things like this. Then you're going to go and you're going to obviously charge according to that, and then you're going to have to do your reporting accordingly, okay? So it's quite a bit of work up front for a small business. So when we do structuring, we try and avoid transfer pricing. It keeps your costs lower, it keeps your hassles lower, it keeps your ongoing reporting and the risks lower, because this is something that they can poke at. That being said, every major company does this, okay? So they would all, like Apple as an example, have a transfer pricing department. Google, Microsoft, Caterpillar, on and on and on. These companies will have a department that goes and deals with transfer pricing. And the reason is because, look, they're doing business in multiple countries, but it's also a great way to reduce their tax, right? They can say, okay, let's put our expenses in places where we have high tax and our income in places where we have low tax, and try and shift the money over in a way that makes sense. So there's lots of different ways that it happens. Apple uses something called an advanced pricing arrangement, and they do something called a cost-sharing agreement. So a cost-sharing agreement means the Apple subsidiary pays part of the expenses of the parent for, say, research and development, and in trade gets rights to be the sole distributor in a certain part of the world. And the advanced pricing arrangement part of it means that they go to the IRS in advance, in this case it's the IRS, and they go and they say, okay, great, here's what we think is fair, and they agree to it in advance so that they know there's no issues down the road. So very useful if you're in a situation where that really makes sense. However, again, more work up front, more hassles. So it's just something you need to be aware of. You need to be aware of, okay, am I doing business with entities or people in multiple countries? Are they related? If they are there transfer pricing rules? If there are transfer pricing rules, what are they? Okay. Do I fall under the definition of a related party? And sometimes they're very broad. Sometimes they're less broad. Okay. Then what do I need to do in terms of studies, etc., and get the right pricing? And then what do I need to do in terms of reporting? So sometimes you don't need much reporting at all. Sometimes you need a lot of reporting. So that's that. If you need help, reach out to us, and we're going to talk to you on the next video.